So when we left, we had learned a lot of content on the beginning, right? Insurance is a contract. We learned all of the amazing distinctions that the state wants us to know. And we're going to just use that so it's easier to navigate. Can I hide that? I'll hide that. Where did all of our Facebook go? Ay, ay, ay. I'm a work in progress here. Yep, grabbed the wrong login. Let's get out of there. Who are you talking to, Kevin? Are you texting? Is that talk to text? Oh. How much? What is the interest rate he's getting? Really? Oh, wow. So what's his payment going to be at? No, I don't. Oh. Wow. It's double my mortgage. Wow. Yeah, my mortgage is like $2,000. With you do impounds though? Impound account? Yeah. So you knew exactly when to move into a better mortgage when that mortgage dropped to like, or interest rates dropped to like 2.37, huh? Yeah, it just, yeah. Oh, yeah. Uh-huh. Wow. Oh, that's good. It's all about professionalism, what's best for the client too, right? So all those people that you did the mortgage loans for, you know their finances. They already trust you with that. This insurance thing is going to be an easy segue. Even just like term insurance to protect their home. Yeah, permanent insurance, yeah. And then you get the Medicare, and then you get the annuities. I mean, oh yeah, yeah. Yeah, there's companies, and I won't tell you what names, but they'll be like, okay, guess what, Kevin? Come work with us. We're going to partner you with an agent. You're going to share your commission, but the positive side is you don't ruin what you've got over here, right? Because now you could really split it, and you have somebody else working with that client. You're just doing the introduction. You don't have to do anything. You're just doing the introduction. Yeah, the trust. Yeah, for sure. And you can build a relationship with an agent that would let you do that too, right? And a company that will let you do that. But you also like you want to be able to do what's best for the client, as you said, right? Yeah. At State Farm. Oh wait, no, he's not at State Farm. Jake left State Farm. Just kidding. I haven't seen a State Farm with Jake lately. Is he? I haven't seen him. Huh. Insurance companies are looking for ideally insurable risks, right? So if you have a client that owns a house, that has a family, it's financially stable, that's a good candidate, right? They're also going to look at their health, right? We hope everybody would be able to get insurance, but that's not necessarily true. I had a few declinations in my time. Sad to say, one declination was one of my cousins, not her specifically, her husband. And they wouldn't tell me why they declined. They said, you can ask the client, but we're not disclosing. Well, she was my cousin, so of course she told me. Unfortunately, it was a domestic violence. What? I know.
Conviction, felony conviction,
Not felony. Well, I don't know what it fell into, but because her husband had a domestic violence, they did not approve the policy. And I was like, whoa, what's that about? So she told me, and that's how I found out that they had been dealing with some domestic violence. Didn't know it before. Couldn't tell before. No, current wife. Well, now ex-wife. Now officially ex-wife. But back then, we're talking about 10 years ago, they were apparently in love, and we thought the face of it was everything was good, and he was declined. Had another client declined. 2 DUIs within 5 years. That was a morale hazard for the insurance company. Within 5 years of them applying for the insurance. Yeah. 2 back to back. Yeah. They asked, the application will say within the last 5 years, have you had any of the following?
And that's why how long did they ask?
Yeah. And it depends on which company, but most is 5, some are 10. So it just depends on the company you're selling for. Yeah. So insurance companies are looking for the ideally insurable risk. In chapter 2 of the life class, we'll learn about the underwriting process. But in this definition of ideally insurable risk, what are they looking for? Something that's uncertain due to chance, accidental, and it cannot be catastrophic. Why does it say must be catastrophic then? Well, this is an except question. Whenever you see the equals with a line through it, that means it's a aha moment for you to remember that the state will ask you an except question on that concept. So for them to say it must be catastrophic, it's not true. That's why it's the right answer. All the following is true except cannot be catastrophic. Look what happened to the fires in Paradise. Look what happened to the flooding in Katrina. I mean, look what happened with COVID, but actually they're not saying that COVID created a catastrophic event for insurance companies. Insurance companies. And they
denied them because of the fear of COVID. And they were just basically denying every submittal.
Oh, I didn't know that.
For like 4 or 5 months.
Wow.
Just saying that, you did a shot. Well, and then when the shot came out, that was another issue. Is that it was considered experimental.
Oh, to the insurance companies.
Yeah, but eventually AAA Life said, no, we'll take it. Like even the pandemic, COVID, if you had COVID, like we'll take it.
Yeah.
Now it's just a virus. Like if you had it,
yeah. Yeah.
Now, I thought it was very interesting that they were underwriting for COVID and then the shot.
Yeah, they didn't know what to do with it. It was something unknown for them, for sure. They're still dying after taking the shot, which is still kind of weird. As you said, they had to underwrite for it because they didn't know, right? Is it really accidental? Is it? Yeah, they didn't have the study.
Can't really do a whole like underwriting.
Yeah.
Like,
what do we do?
Yeah.
Yeah. And the other part of it too is they didn't have like the injuries, right? They were not allowing the injuries to be posted or to be, they weren't saying it's a result of the shot, right? They were just saying that was something you had before, and yeah, and it just brought it to the surface. But you already had that, right? Yeah. We had a cousin of ours that worked for the billing department
And he's also-
in a hospital, and she did. She saw something going on, and she started questioning it. She actually left the company because she was like, "No, like I'm not doing that." So we found out, just by somebody sharing with us what was going on. But not a lot of people know all that stuff. That we're too busy with life to pay attention to all that, All right. So on your state exam, this question for sure, one of them, which one? You might get this one where it says it must be catastrophic. The other one will say must be predictable. Nope, it cannot be predictable. We just said it's uncertain due to chance and accidental. It also must be measurable. Well, how do we measure it? In life insurance, it's based upon the death benefit that we sold to our clients. So if I sold you $1 million and you're penniless when you die, they're still going to give you $1 million. If you only bought 100,000, but your family needs $1 million, doesn't matter. I only sold you 100,000. Your family will only get 100,000. So it's, again, in life insurance, it's measured based upon the death benefit in the policy or policies, because I can also sell you several policies. Make sense? So it's an ideally insurable risk is uncertain due to chance, accidental, and it must be measurable. Cannot be predictable, cannot be catastrophic. When you're buying a policy on someone else's life, all those girlfriends we were talking about, Alejandro, well, guess what? You must prove insurable interest. Now, how do you prove insurable interest? You can remember it by remembering the acronym FEE, which stands for financial, emotional, or economic interest in the safety or preservation of the life of the property being insured. Did you get that?
Yeah, can you show
Oh, this one? Ideally insurable risk? C is insurable interest. Yeah. Financial, economic, or emotional. Yeah. So you have to prove that you have one of those three. Another way to remember it is love. That's what the heart is. Blood relation, or money. So right now, Kevin has no insurable interest on you, right, Alejandro? You just met him in class.
Sure.
But he just loaned you $100,000. So since he just lent you $100,000, now he has insurable interest on you because there's money connection. Make sense? I don't know if you know this, but Jake back there, he's your long lost brother. Yeah, your dad had him very young. You guys found each other. Now there's blood relation, right? Same dad. Can he buy life insurance on you? Yeah, okay, because there's blood relation.
It's a true story, but my long lost brother was overseas. So,
Really?
he brought up
Really? Oh, I'm like, wow, we're connected here.
we didn't buy life insurance.
Oh, you didn't buy life insurance. How old is your long lost brother?
Well, he's half brother and 26.
Wow, how'd you find him?
The DNA stuff.
No way.
Yeah, 23andMe. I asked my stepmother, I'm like, who's overseas? She's like, oh, he was my son. My dad's really old and she's really young.
Yeah.
And I think he's 30.
Uh-huh.
But yeah, we didn't know that we had a half brother. My dad had other children.
Wow, interesting. You asked your
Yeah,
stepmother.
we did a DNA test. Found that he was my half brother.
Wow, how crazy is that? Yeah.
Now
Do you-
you say bring up life insurance.
You're gonna go buy it some.
No, but in that case, long lost brother, or if you loan someone $100,000, you have an insurable interest, but they still have to sign the paperwork.
They still have to agree. That
Unless
is
it's the
correct.
baby, unless it's the baby owns it.
Right, right.
And then it would be the parents' agreement.
Exactly. But you still, yeah, exactly. So grandma and grandpa can buy on grandchild, but parents have to agree for that child.
Yeah.
Yeah, for sure.
Yeah, you just can't go out and buy a policy.
No.
It's insurable interest. That's completely parties on both sides.
Absolutely. Yeah.
But
And-
the test,
For the test, love, blood, or money. So all the women that he loves, Alejandro loves, he can go buy life insurance on them so long as they agree. If they don't agree, you can't buy a policy on their life. So I'll never forget, I was teaching this class, Alejandro, probably back in 2009, and I had a student in my class. He was sitting over here on the left-hand side. At that point in time, I was actually on the board for the National Association of Insurance and Financial Advisors for Silicon Valley. And my job was the sales congress. So I had to get exhibitors, I had to find the agents to come in. So I decided to invite all my students. We sent a massive email. Back then, you couldn't track the emails. You just sent them all out and hope they got them. And when it came down to it, only 2 students responded out of the 5,000 I invited. We've had more students, just 5,000 for, back in that time, we didn't collect emails until like 2003. I think for 6 years, we had some, and then some people didn't, they weren't emails anymore. They had changed emails. So only 5,000 went out. 2 responded. One happened to be one of the students in my class the previous month. But let's rewind to the class. So he's in my class and we're learning about insurable interest. And we're talking about how, you can buy insurance on even that you have love, blood, or money connection. And he's getting visibly upset. And so I turned to him, and we'll call him Mike to, protect his identity. And I said, Mike, what's going on? He says, I'll never believe it. Believe what? Sure, do share. He says, well, I was engaged for a little bit. And when we were engaged, my fiance at the time and I had agreed to get life insurance policies with each other. And what happened was 2 weeks before the wedding, I left her at the altar. And then he starts chuckling a little bit. I'm like, oh, that's a story I want to hear, right? And I said, so why are you so upset? He says, well, you'll never believe this. She still has a policy on my life. But I left her at the altar, but she still has a policy on my life. And I said, so why are you upset? He says, because you reminded me she still has a policy on my life. And I said, yeah, but you had to agree. He said, yeah, I agreed when we were engaged. It seemed fair when we were engaged, but we're not engaged anymore. I said, yeah, but she's a smart lady. He said, that's not nice. Said,
kill me without knowing.
The problem is she kept the policy on his life. Yes, she will.
Life insurance company will dig into it and see that the insurable interest.
Now you're collapsing. Now you're collapsing. You're collapsing life and health and property and casualty. In life and health, you only have to have insurable interest when you buy the policy one time. Property and casualty, you're right, 2 times. But in life insurance, only 1 time. So I'm like, smart lady. Of course, she got even more upset when I said that. And I said, well, you gave her permission. She wouldn't have been able to buy it. So he's like, but I canceled the one on her life. I said, well, that's where you probably shouldn't have, right? So he visually was even more upset. And I said, it's okay, You'll get paid when you die, and you'll never even know. You won't even know. He can't. He's not the policyholder. He's not the policyholder. He's the insured, but he's not the policyholder. You give up that right. That's why when you give insurable interest, when you have insurable interest on somebody, and they allow you to buy a policy on their life, you have to make sure you understand what that means. Or if you give that right to somebody else, you have to. My policy on my life, I'm the policyholder. My policy on my husband's life, my policy on my husband's life is my policy. I'm the policyholder. Now, when you get into like the affluent community, and let's say my husband was an heir to Bill Gates. In that case, I wouldn't want to own the policy, and he shouldn't own the policy on his own life. We would want a trust to own the policy. We'll talk about that in chapter 4. But in this scenario, again, like I said, we got visually upset. And he showed up to the conference that I was telling you about, the sales congress. And I promised every student, if you come to the sales congress, I will introduce you to everybody that will help you in your business. Just tell me what niche you're going to go into. So we're walking around during one of the breakout sessions, and I'm introducing him to people. And all of a sudden, he nudges me pretty hard too. And I was like, what's up with you? He's like, who? And he's really trying to be quiet. And I look up and I'm like, no way. She's on the board with me.
Oh, no.
Not only is she on the board with me, her and I had actually gone to the state conference together. She was my roommate. I knew exactly who she was. I'm all, wow, what a small world. No wonder why she kept the policy. She's in the business, right? Well, you missed that part.
Probably so cheap.
Exactly. So I was in charge of like making sure like the speakers got, dinner and all that. So we all went to some steakhouse. I forgot the name of it, over by what's it called? Over by the Santa Clara Convention Center, but not there. Over by the Marriott. Not at the Marriott. No, around there. There's a steakhouse. No, it's right there. No,
Is it ground floor?
it's Alexander's right next to near the Marriott on that same street.
Basically, say, it's Santana Road.
No. It's Santa Clara.
Oh, Santa Clara.
Yeah, Santa Clara Marriott, by the Santa Clara Marriott. Anyway, long story short, we're sitting because he came to the sales congress, I'm like, oh, come to, not knowing, okay, this is before I invited him to go to dinner with me and the speakers. Well, she's on the board. So of course she's going to go too. Me not knowing this before I invited him. Oh my gosh. She sat right across from us. He was right next to me. At one point, I was like, can we switch seats? He's like, why? I'm like, I just need to make sure I can talk to the speaker because he was sitting next to one of the speakers. Oh my gosh, the two of them were just talking. I'm like, I don't even want to hear it. Like, it's uncomfortable for me. When you get caught in that situation. Never forget that story. Never forget it. Insurable interest. Once you give somebody permission, hands off. You're done. You only have to prove insurable interest at the time of purchase. Now, on the state exam, they'll say at time of inception. That's the same thing, okay? Time of application, time of inception, time of purchase means the same thing. For life insurance, it's only one time. One time. Property and casualty, it's 2 times, okay? Property and casualty. Auto, homeowners. You have this amazing yacht that you sold to your friend Jake. Jake was so excited that he got to, buy your yacht from you, that he goes and he takes it on a spin right here in the bay. Not sure what happened. I think he had a couple, drinks.
Oh, yeah, I definitely did.
And he somehow lost control of the yacht and he couldn't course correct, and he actually ran into a pier and he damaged the boat. He's okay though. He's okay. But the boat took a big hit. Now, you forgot to call your agent to remove the yacht from your policy, and he forgot to call his agent to add the boat to his policy because he was so excited. Unfortunately, with all that damage to the boat, what happens? Can you submit a claim on your policy? Well, you forgot to remove the boat, so it's still on your policy. You've been paying premiums the whole time. He forgot to add the boat to his policy. So can you submit the claim?
It really depends on how you and I work it out before we file a claim. However, you're not
Legally.
your policy because you had no insurable interest once you gave it to me, whether or not it was on the policy. And I don't have an insurable interest. Well, unless my insurance company allows the 10 days, 5 days, they allow you to do a transfer, but I didn't transfer it on my policy when I took control
So you don't have an, yes.
For a test. It wasn't like he was paying for a test.
No, he already bought it. He was so excited he bought it. So he got so excited that he bought it from you, that he was able to buy it. He took it out without insuring it. And again, you forgot to call to cancel it. Can you submit the claim? The answer is no. Why? You don't have insurable interest. You already sold it. Well, what about all the premiums you're paying for that time? You can call them and say, hey, you know, I lost insurable interest on this date. Can you pay me retro? Now, when you call 800 numbers, they always say, no, we can only give you 30 days. That's a lie. Because you have to know to say, well, I lost insurable interest on this date, which means your company's liability was lost on that day. So you have to give me back all the way to the date of transfer. Sometimes you have to tell the 800 number lady that, or person that, because they are telling you what they are supposed to tell you, which is 30 days. But the truth is, they have to legally give you everything. Right? They should be telling you the truth. I think you should. I'll sign your petition. Yeah. So just remember, because you no longer have insurable interest, if you were to have submitted the claim, it would be fraud. You would get in trouble for fraud because you submitted the claim. Now, another big thing that's hit the news, I don't know if you heard about it, was Walmart. You guys hear about what happened with Walmart? Walmart, they have what's called business insurance on their key person. It's called key person insurance. Okay? Key person insurance says that because Alejandro creates 60% of your business revenue, you have the right to buy a policy on him if he allows you to. So you do. But then you leave the company, but you still keep the policy in his life. How is that possible? Well, because under insurable interest, you only had to prove when you purchased the policy. He gave you permission. It's his fault he left your company, but you're still going to keep the policy on his life. So Walmart was doing this. Walmart has made a killing on keeping policies on their key persons. It hit the news. It hit the news. Yeah.
Don't corporations do that anyways?
Well, corporations will use buy-sell agreements to be able to buy back stock from the heirs, save them answer. But when it comes to key person, you only can buy, yes, insurance on the key person. That key person has to agree. But if it's part of the agreement to come work for us that we have to buy a policy in your life, you're going to say yes. So all these executives that, went to go work for Walmart, they gave permission, but the families didn't know. So here the families find out that there's a life insurance policy on their loved one's life, and Walmart gets the money.
And they can't write another one because it's already going on.
They can, up to the human life value. But the families were finding out after the fact.
But doesn't that cause a problem? So I work for you, you're Walmart, you get a key person.
Yeah.
Say $1 million.
You're my key person. Uh-huh.
I'm your key person.
Yeah.
I fulfill my obligation to the company, whether I'm on contract or direct employment, but I decided to go work for
ABC.
ABC, similar to Walmart.
Yeah.
And you keep the policy, but now they require one. They are getting a key person because now I'm their key person.
Yeah.
And so let's say throughout my career, I've held CEO positions at 6 different companies. All 6 of them have a policy. Does that hurt the
So long as it doesn't,
underwriting and marketing?
as long as it doesn't affect the human life value, right? So I can have a policy on you for 5 million, but if your human life value is 10 million and Alejandro bought one for 5 million, now you're capped. If our friend Kevin wants to buy one on you, they say it's going to be, not possible because of your human life value.
Yeah.
But if Kevin doesn't know that we have policies on your life, and he submits an application for the 10 million, your human life value, who's to say that he can't have it unless they find that you have a policy under MIB? They should find that you have a policy.
Yeah.
Yeah.
That was one risk.
The company. Yeah.
Yeah, I think 2 years ago, you can catch, I still have it now. Even though the one we're 10, I put another 10, I was 20.
Yep.
Still run because inadmissibility is under 2 years and you can't.
Chapter 4.
You should have done your homework before you offered me this thing. You already had 2 more.
Yeah.
And so since Walmart initiated the key person
Policy.
for the value, this guy would either get other policies that might not be able to be paid, or other companies have gotten policies that might not be able to be paid. Or would they all pay him out if like he retires?
Remember what he just said. If the policy's in place, after 2 years, the policy becomes incontestable. If the
Yeah.
insurance company didn't do their due diligence to find out how much insurance was on your life,
Yeah.
right? Then it's on them.
Yeah.
It's on them.
But if they find out Walmart has a 10 million policy on
Then
We gotta
the,
do
then technically what they're going to say is you can only buy a million on him based upon his human life capacity. You can only buy a million, or no, you can't. The insurance companies won't make the decision, but you got to look and see, like, once again, like the human life value cap, right?
Yeah.
What is it? What
Well,
does it become? And most companies are not going to pay for a $10 million policy on your life.
Yeah.
They're going to limit how much they put on your life. 200,000, 300,000, right? They're not going to be like 30 million, right? Now, when you, this is what I heard, investment advisors, sometimes they want, because they're going to give you so much money for your invention and you're the brains behind it all, Alejandro, they're going to ask for insurance based upon the value of that, potential that you have. And in that case, because you do have this amazing ability to create and innovate, the insurance company will say, is that really, the value? Yeah. So again, it's just the insurance company's underwriting department that's going to decide, is that too much insurance? That's one of the questions that'll ask on the application. Do you own other policies?
Yeah.
Right? And so that's where you have to disclose it.
No.
After 2 years, like Kevin said, it's incontestable, even if they lied. We're going to talk about that in chapter 4.
If I know there's other policies,
Yes.
If I really don't know.
Which is a moral hazard to the insurance company without the E. It's intentional. It's deliberate. Right? If they catch it, great. If they don't catch it after 2 years, right? It becomes incontestable after 2 years. Emotional, economic, emotional, and financial. Love. If his fiance, they're not married yet. Emotional connection.
If we are now unmarried, this policy becomes null.
You want to do that in a trust.
Yeah, but I had to do that.
So you have the trust on it.
We had to stipulate in the trust what happens if we divorce, because she could have kept that policy running. Even if,
Why wouldn't you keep?
she wanted that policy, but I have a friend who gets like, but in our trust, it says once we divorce, we're going to be responsible for any policies that are in our name or that separated. I did.
No way.
Yeah, well, because we stipulated it prior. Yeah, we created that before we got life insurance. Yeah. Well, I was life insurance. Well, I was an insurance agent at the time, so I'm like, I don't want her to keep a policy.
What to do.
Yeah.
Just like, you know what to do.
However, Social Security, she will always have access to unless they marry someone longer than.
She still gets it.
Longer? Oh, really?
So long
Now the social security insurance information, I couldn't get out of it. Even though I said that this pertains to all insurance.
That's
Social Security.
social security. You don't control that.
But
You can't control
I
that.
can't, yeah. Neither can she, but,
So it's okay. So long as you don't get remarried, who makes more money, you or her?
um,
Okay. You don't want that to get rid of that.
well,
'Cause- How young are you? How young are you?
I'm 50.
50. We got some time to go.
Okay.
But,
Yeah.
you know, you get to look at your social security and say, oh, which one's better?
Yeah.
Right? Do I want hers or do I want mine?
Yeah.
So it works out both ways. That's a good one. I would have kept the policy. How old are your kids?
Sorry?
How young are your kids?
20.
Only one? One. I would have kept the policy just for the kids.
We don't have to be responsible for, so we still both have. I took over
Yours.
my own stuff. And I'm my own beneficiary.
Who's the beneficiary?
My brother. His trust.
Okay.
His trust.
Oh, nice. You didn't put it in a for your son?
He was too young at the time when we created it, and I got bored, so. As a minor, there's always loopholes.
Yeah. And so now you got to change it, right?
Yeah.
Yeah. I just changed my beneficiaries.
Well,
My,
I changed mine.
yeah.
I'm in the process of changing
My
mine.
son's 21, so I did the same thing. My baby's 21 now. No guardians needed. We'll change the. All right.
I'm changing. I'm actually changing mine.
Yeah.
I just started the other business too.
What other business? The bail.
Bail ones.
Oh. Yeah, you better get something on yourself for that one. More insurance.
Yeah.
All right. There's 5 ways of managing risk. The acronym is STAR. In fact, you will see STAR on your test. They'll say the R in STAR stands for, and you have to know what this is. So again, there's 5 ways of managing risk. S is for sharing. Do you have a BFF that will share the risk with you? Something happens? Will cover your part of the risk? Alejandro, you have any friends? You get a pickle, they'll help pay your way?
Possibly.
Possibly? I don't have any friends, just my husband. That's my BFF, my husband. But I don't have any close friends that if something happens, I can say, hey, I have this happen. Will you pay half? Yeah. Now, remember what our mommy taught us when we were growing up? Sharing is caring. Yeah. Or we taught our kids that. I don't think it was a thing back then. Yeah. They taught you sharing is caring. Yeah. COVID changed all that for sure. You don't have to share anything. Jeez.
All right, when it comes to insurance companies though, how they're gonna share the risk is that they're gonna share the risk with other insurance companies. Now, why would they do that? You have a client that wants $10 million of insurance. Your company, let's say ABC, has a retention limit that the Department of Insurance gave them based upon how much money is in the reserves. They have a retention limit. This retention limit basically is the limit of risk that an insurance company can retain on their books on one property or person. But they think it's a $5 million limit, your client wants 10 million, they have to share the risk with another insurance company to be able to cover that client. Okay? Now, if an insurance company like ABC has to find the reinsurance to cover the top 5 million of the policy, the client has no idea this is going on. It's all happening in the background. Okay? So your client submits an application for 10 million, you go to your boss, you're gonna have this application for 10 million, and your boss, manager, will go and find a reinsurance company to insure the top 10 million. will submit a claim to their reinsurer for that top 5 million. Let me say it again, the client has no clue this is going on in the back office, so the client is clueless to.
What we use,
Able to do it because of the reinsurance that they have on that client.
but it has no association with the word we used earlier, like, you ruined my car, I'm paying for it, and I'm going after you. Okay. The main is your action. That's more individual stuff, not policy.
This is an insurance company. Yeah. Now, state that question, they'll say, what's the name of what's the name of the insurance company that provides the reinsurance? You ready for this? Did I tell you words what they say? The name of the company is the reinsurer.
Reinsurer, yeah.
Their name?
The name of the company that,
No. See, the primary insurer is ABC, right? Fine, you want ABC, the primary insurer is ABC. What's the name of the company that's reinsuring the risk is the reinsurer. They're not the secondary insurer, they're the reinsurer. Okay? Sense? Did I say words mean what they say? You are finding it to be true? That makes it very simple, if you keep it simple. Don't overanalyze. Now, there's two types of reinsurance contracts. The first one's called facultative. Facultative comes from the root word facilitate. So if I have to facilitate each contract with a reinsurer and find a reinsurer to insure my clients, it's called facultative reinsurance. Every client I have to negotiate reinsurance for. For every client, I have to facilitate a contract for every client. Okay? Not to be confused with treaty reinsurance. So there's facultative and then treaty. What's a treaty? So I may see your XYZ and you say, Jackie, I'm gonna insure all your reinsurances. We have it in writing, in agreement, and no matter who I bring to the table, you're going to be my reinsurer.
Yeah, the reinsurer, there might be no individual policy, I might be liable for it.
Well, you and I both agree on certain underwriting guidelines.
Yeah.
So you and I are on the same page, right? So we're not gonna insure all the risk. We're gonna insure the protected. We both have the same consensus, right? So the reinsurance agreement is just basically you saying, yeah, Jackie, I trust you. We're gonna cover all your risks, all your reinsurance risks. Okay, that's treaty and reinsurance. But facultative means I have to facilitate for each client which reinsurance company am I gonna have. That risk. Does that make sense? You may or may not get that question. What do you mean? I don't know which question you're gonna get. You might just get the one that says, what's the name of the insurer that reinsures a risk? Reinsurer. There's so many questions in that concept piece, so you have to know the concept. It's gonna be one question on reinsurance for which one? Let me know if you remember. Let me know. What's the purpose of reinsurance? To expand the capacity of the insurer. What's the name of the insurance company that needs reinsurance? Primary insurance.
oh, primary insurance.
Yeah.
That's all you.
No, it could be property and casualty as well. Yeah. I have a house, you have homes in the hills over there
In Santa Cruz that are worth 15 million. But AAA has a retention limit of 10 million. They're gonna find you.
23 billion. That's weird.
Really? Only 10 million?
Well, 10 million for underwriting and policy.
Yeah.
Policy, but they will reconstruct it up to 20 million. They're already in the hole. Like, for the, reconstruction model.
Huh.
And then
Which is weird. It's the weirdest one. So it's in Orange and State Farm. And I've seen Liberty Mutuals. And it's like AAA is the only one that'll do a reconstruction model up to 20 million.
Wow.
But they'll only insure it up to 10, which is
310?
Yeah, I mean, it's either a reconstruction model over 10 million, you're not right.
But how many people are really gonna need reconstruction at 20 million? The house might be valued at 20 million, but to rebuild, what is it?
Yeah. it's probably 10.
Yeah.
Rebuild, like, at least 50.
Because
The
only
square
one
footage.
line is land, it's probably half the time.
Yeah.
So yeah.
It's okay. Another way to manage risk is to transfer it. We just talked about that. When you buy insurance, you are transferring the risk. Another way to transfer the risk is to sue the other party at fault. What? Yeah, it takes a longer time, by the way, and I don't recommend it, but you could sue the other party at fault if you want to transfer the risk that way. But then you're leaving it up to the courts. The best way to transfer is just buy insurance. State exam question. A purchase of an insurance policy by a consumer is known as risk transfer. Yeah. Make sense?
Purchase of
The purchase of an insurance policy by a consumer is risk, and the answer is transfer. Any questions? I'm doing it right now. I'm teaching a class though. I'm going to be on break in a few minutes. Okay, bye. Sorry about that. Any questions about that? Say that again?
So he's transferring, if I don't have life insurance, me transferring my possible death, the risk of me dying too early. I'm buying an insurance policy and that is transferring my risk
To the insurance company. Yeah. Okay. Now, I forgot to tell you the class rules. I apologize ahead of time or after the fact. Rule number 1, do your best to be on time from breaks. You guys are going to be fine with that. I'm not going to be worried about it, but I just have to say it. Number 2, no cell phones. You guys are great at that too. I haven't seen any problems with that. Number 3, ready? Sometimes I'm going to say something that might offend you. I'm apologizing now. You know what that means? If I offend you, you have to just get over it because I already apologized. All right. Rule number 4. You ready? This is the most important of them all. Okay. Teaching this class for over 20 years, I have come up with some what I think are great jokes or sayings. Okay. Now, it is in your best interest, even that if it's not funny to you, that you laugh anyway. Okay. Number 1, the reason why. Here's the why. Here's the psychology behind it. When you tie emotion to data, you tend to remember the data a lot longer. If you don't believe me, let me give you an example. We're going to pick on Kevin. Why? Sorry, Kevin. Kevin, do you remember the first person that broke your heart? What's her name? Oh, you even, and you know her last name. Do you remember where she lives?
Yes.
What year was that?
1988.
That's a long time ago. Oh, sorry to hear that. Do you still talk? Really? Were you connected through Facebook or what? And then she broke your heart again, or you broke her heart this time? Yeah. And he will never forget Dana, ever, ever, ever. She will own a place, a little piece of his heart. She will never pay rent, but she'll always own a little piece of his heart. Forever and ever, because of that emotional connection. There you go.
Me and ADHD. Right here.
Yeah. So what's cool is that you remember her, right? That's cool. So you're probably wondering, what does this have to do with passing the test? It's the emotion. When we have you laugh in class, even though it may not be funny to you, if you laugh anyway, you'll remember the content. You'll be sitting at the test, you'll be remembering avoiding risk for some reason. Why do I remember avoiding risk? That was because Jackie said guys were good at that. Rule number 3 and rule number 4. Remember, if I offended you, I apologize ahead of time. But rule number 4, again, laugh anyway, even if it's not funny. I appreciate courtesy laughs. If it's really not funny, don't laugh. That way I know to take it out of the conversation. But yeah, avoiding risk. Guys are good at this. Winnie, I'm telling you right straight. You look young. How young are you? See, you're learning it at a very young age. Men like to avoid things. Alejandro's laughing because he knows it's true. Alejandro walks into a bar, right? Are you married, Alejandro? You have a He already has a victim, so when he walks into a bar, he doesn't want any drama with his girlfriend. So he walks into the bar and he avoids all of it. He just goes around and he fully ignores it because he doesn't want any problems. Guys, I like that with commitment too, though. Oh, come on, that was funny.
I'm not like that. I say something.
So she's good at it. Oh, well, she probably learned it from you. I'm just kidding. I'm just kidding. Thank you. We learn from each other, don't we? Yeah. I think I avoid now more than my husband does, to be honest with you. But I learn from him. All right.
And he doesn't even know you.
Yeah. Avoiding. How do insurance companies avoid risk? They decline applications or they'll reject the applications. How do we reduce the risk? Well, contingent upon, what we're talking about, like what policy, right? Insurance companies reduce the risk if they see clients that are going to the gym, they have a healthy lifestyle, they don't smoke, they like those clients, right? So how do we reduce risk? We don't smoke, we don't, unfortunately, I still do that. We wear a seatbelt, right? We wear a seatbelt. Yeah, we want to have healthy lifestyles. And some of us, no matter what, we don't like to share, even though we were taught sharing is caring. We don't like to share. We don't like to transfer it because we love risk so much. We're certainly not going to avoid it, and we're not going to reduce it because we love risk so much. So we just hold on to it all by ourselves. We just hold on to that risk. It's called retention. Retaining risk is not buying insurance. So if you don't buy insurance, you are retaining risk, right? So do you have Medicare? No, we should not have, we're too young for Medicare. How young are you? 63. You don't have Medicare either. In a couple more years. And you said your wife received the messages already. She almost hit 6. She got it at 64. They start sending out letters at 64 and a half. Yeah. If she wants to stay with her doctor and she's an HMO, then she has to stay in the HMO system. That's the whole thing. Oh yeah, so she can avoid paying for, yeah, especially if she's still. Ouch.
So wait, what happens if you're 65 qualified for Medicare? Right?
You get Medicare Part A regardless at 65 if you have enough credits. We're going to learn about this. You might want to stay in the class just for funsies. Just for funsies. Now, for the other question you were asking, so what happens when you're 65?
You're 65, you're offered
Medicare, Medicare Part A is automatic. You get it, no ifs, ands, buts about it. If you're still working, because we are supposed to retire at 67, right? We
Yeah.
can't retire at 65 like everybody else. So at 67, when we can retire, they say, then we can stay on our group plan until 67. But if we're not working, right, we retired early and we took an early retirement at 62 maybe, and we have Medicare 65, we have to sign up for Medicare Part B. If we don't sign up for Medicare Part B, FYI, at age 65, you have to pay a penalty of 10% for every year that you did not enroll. My dad took that hit. 10 years. He didn't apply for Medicare Part B until he was 75. So it was 100. He was working, but his company didn't have real insurance. What his company had was a doctor that if you got sick, you went to this doctor. So it was like being self-insured, but not really. And he didn't have insurance. So since he couldn't prove he had insurance while he was working for this company, because they were self-insured in a different way, then long story short, it was 100% penalty, because 10% for every year, 10 years is 100%. Now, luckily, he qualifies for Medi-Cal. So luckily that got wiped out, but for 2 months, he had to pay that penalty.
That's exactly.
Then she can prove that she has set her health through work and she can avoid the B. She should ask for it. She should ask for it for sure. It's called Medicare. She has to appeal. It's called an appeal. And you appeal Medicare Part B at the Medicare office. And she just goes to Medicare and says that, hey, I have group health this whole time. Well, yeah.
Well, just get a printout. You can ask your employer for all your
Proof. What I would do.
They have to send you showing how long of what months you were insured and type plan.
What I would do is we have a trainer that teaches the Medicare. She knows all that stuff. I can give you her number too if you want to. Yeah. Who are you going to work for with Medicare? No, who's your who are you going to work for to sell Medicare? Senior Life Matters. Yeah, she should know too. If she doesn't, then you might want to rethink. Sorry, I'm just kidding. She should know how to handle that. She could probably help you. Well, yeah. 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 She was in Medicare Part B or she's in Medicare Part C? Well, A is automatic. So what does she have? No, yeah. You know, the best thing to do is bring in, if she's willing to allow you, because it's personal information, allow us her to bring her stuff in, you to bring her stuff in, and then we can look at it. But here's the thing, like there's a lot of people that don't buy insurance and they retain the risk, right? So exam answer, when you don't buy insurance, you retain the risk. When you buy your medical plans, you have what's called cost sharing provisions. We're going to go over this in chapter 8. We're going to preview it now, okay? The cost sharing provisions, I said words mean what they say. This is an exception to that rule. Cost sharing provisions does not mean that the insurance company is sharing the cost with you. It does not mean that at all. It's a form of retaining risk. Let me give you the example. If I have a $6,300 deductible and I go to the hospital and the hospital bills $4,000, how much will the insurance company pay, Winnie? My deductible is $6,300, my bill's $4,000. If my deductible is 6,300, that means I have to pay 6,300 out of pocket first before the insurance company pays anything. Ouch. I'm retaining $6,300 of risk if I end up in the hospital. Now, some people do it because they don't like to go to the doctor, number one, and number two, they don't get sick, right?
Well,
If I get sick, I go to my chiropractor and get an adjustment. That doesn't help me in my medical because my medical doesn't pay my chiropractic. I have to pay out of pocket for that, right? I'm retaining the risk. But I know every time I get sick, I'm going to go to my chiropractor, not to my primary care physician.
And that's because your body responds better when it's
Because
not-
because I believe that most of the things that I have health-wise have been helped in the past with chiropractic. My allergies, gone, right? So that's just my belief. Everybody has their own belief. So I would have somebody I would be somebody that would have a high deductible, right? Now I'm really lucky because I don't have a deductible. My husband works for Teamsters. He's a Teamster, I should say. They've got great insurance. We don't have a co-payment. We don't have co-insurance. With Kaiser, of course, it's real easy, right? We don't pay anything. Not everybody's not so lucky.
So we definitely take that as
No, we pay for the insurance. In fact, we pay not only for his insurance, but we pay for lifetime medical for all the guys. Yeah. He gets like $600 out of his check every month is just for lifetime medical for all the other guys. But that's what they voted on, so that's what he has to do.
my wife works for
Wow, nice. That's your deductible. Wow. No co-payments to see the doctors?
Now I'm gonna meet you because she's
Ah.
paid $20 a visit, $30
So you have retained the risk, okay? You have retained the risk of co-payments of $20. If she would have picked a $50 copay, her premiums for that plan would be lower because the more you retain, the less you pay. Make sense? If I go and I'm like, I just want a $500 deductible, my premiums are going to skyrocket. But if I ask for a high deductible, my premiums go down. It has an inverse effect. Does that make sense?
Yeah.
If I ask for a high out-of-pocket limit, that also reduces my premium because I'm retaining more risk. Does that make sense? I'm transferring less risk. When we learn about the medical plans that we have under PPACA, our Patient Protection Affordable Care Act, known as Obamacare, no longer known as Obamacare. From now on, you got to call it PPACA so you don't forget. The Patient Protection Affordable Care Act, we have these metal tiers. So platinum being the highest, you're retaining only 10%, and the insurance company pays 90%. You're only paying 10%. So you have transferred so much risk. What happens to your premiums? 80-20, my premium goes down a bit. 70-30, 60-40. 60-40 being the lowest premium of them all because I'm retaining 40% of the risk. Make sense? And then I also get to pick the out-of-pocket maximum. You're saying your out-of-pocket maximum is $1,500. That means he has to pay up to $1,500 and then he's done. So if you're looking at this right here, usually the deductibles are, let's pretend 500 in this scenario. The out-of-pocket maximum is 5,500, which means after the deductible has been satisfied, the insurance company and the patient will share the covered losses in this proportion, okay? 80-20, up to the 5,500 limit. You said yours is 1,500. That's pretty low. But then after that limit, the out-of-pocket maximum is reached. Out-of-pocket limit is also another way they'll say that. Words mean what they say. The insurance company will pay 100% of all charges for the rest of the year.
So on the co-insurance, so on the deductible side, there's a deductible. And then-
You pay that before the insurance company pays anything.
Yes, you pay that, that's your upfront cost. And you might have a copay for every time you go.
Mhm.
See a doctor. Go to the doctor, $50 copay. They say you need surgery on your arm, $1,500 surgery, $1,500 reduced from your $630 deductible.
Yeah.
And
Wait,
then
say that
once I
again.
meet
Wait,
the
say that again.
So let's say I go to a doctor, I pay my copay.
Yeah.
I see the doctor says, hey, you have a broken arm, you need surgery, you have surgery, $1,500.
Mhm.
That goes towards your $6,300.
Well, let's just say, let's be real. Surgery is going to cost you like $20,000.
Okay. You pay the first $6,300. They cover that.
No, you cover the 6,300. They cover
I
the
cover the $6,300.
under deductible
And the first 20%.
and the next 20%.
And the next 20%.
Up
If I have that gold plan,
Yeah.
okay.
Yeah.
So depending on the plan, 60/40, 70/30.
Yeah.
In this scenario, we're using 80/20.
Yep.
Now on the test.
On this scenario, we're using let's look at this scenario. On this scenario, we're using $500 deductible, not the 6,300. This is something. This is a student. This is one of the students' plans that I was like, what?
Yeah.
Okay. So in this scenario, we're using a $500 deductible. The cost for that surgery is $20,000. Up front, you're paying $500. That means the $19,500 is the 80/20 coinsurance. Now, if we take 20% of $19,500, we're at how much?
1900, 20 times.
20 times 19,500? 40 what? 3,400. 3,400 plus 500. You're not at your max yet. Yeah. Let's say it's $40,000. Okay. 40,000, you pay your 500 is 39,500. 20% of 39,500 is 7,000 plus the 500. Now they're like, no. You're not going to have to pay 7,900. You'll just pay 5,500. Now be careful on the state exam. If it says that the 5,500 is inclusive of the deductible, then the max out of pocket is 5,500.
Yeah.
But if it makes no mention of the deductible, then that's 5,500 plus 500 is 6,000. So that's where you got to be a little bit careful on that.
What about family?
Family deductible, state exam question, family deductible, one deductible for the entire family. So once you meet the family deductible, your wife, she goes to the hospital, she doesn't have a deductible because you met it.
1,400. I had all these operations, she hasn't had much, so the extra
What's your family deductible? I don't assume that. It just depends on what's in the policy. No. Let's say she goes to the hospital and she pays the family, the amount of the family deductible is, let's say it's $1,000. Okay. And she had to meet that deductible. Now you go to the hospital, your bill's 40,000. She already met the family deductible. Goes straight to the 80/20 coinsurance clause until your out-of-pocket maximum's been met. Yeah. But do you have a deductible every time you go to a surgery? So you have a per cause deductible is what it sounds like. Annual deductible? Okay, good.
My question.
No, it's usually in a family policy, you have a family deductible, usually. Yeah. If it's a family policy, it's a family deductible, usually. But again, if she chose a plan where it's an all cause deductible, it means every cause you have a deductible, that lowers your premium because you're gonna be paying a deductible every time, right? Versus a family deductible, once it's met, everybody's met. Wow. Are you on Cobra? She didn't remove. Right, right.
Medicare, she has a plus, what we said, I would be just ask her
Dependent.
to make it.
Yeah, because she's on Medicare. Medicare's going to pay, you know, her based upon the benefits that Medicare pays. Yeah, it gets very convoluted when you look at it. Yeah, but if she's on Medicare, Medicare Part A is, like I said, Medicare Part A is automatic when she turns 65. If she's still on the group plan, which she has the option to do on the group plan, why didn't she just stay on the group plan? They cannot legally force her to go to Medicare because it's age discrimination under TEFRA. They're pushing. I would get a hold of all that documentation, and if she was forced out, she should call a senior advocacy company to advocate for her, and not just her, everybody in her company that's happening to. Yeah, because that should not happen. It's under TEFRA where it says age discrimination is not allowed.
So is that also called a medical?
It's a medical. That's the whole thing. Yeah, Medicare is medical. Yeah. So no, you're still enrolled in Medicare Part A. That's part of it. Medicaid will pay the extra stuff. Yeah. Like if you need to go on a Medi plan, then Medi-Cal would step in California's Medi-Cal will pay for the premiums for all that, all the costs. Yeah.
So they can't force you to, so if I'm 65
And you're working.
and I'm working, they can't force you to go on Medicare. You're done with the company.
Right. They can't force you on Medicare, the Advantage programs, Medicare Part B, yeah, or Medicare Part B. That's why you're allowed to unenroll in Part B, right? You're allowed to unenroll so long as you have a group plan already in place, or if you're covered by your spouse. Yeah. Well, there's some people, and I hear this is going on right now, which I think is not cool, where insurance agents are saying, let me do a seminar for your 65 and older crew. Let me show them our plan over here, which is a great benefit, and let them opt out of your group plan. The moment they opt out of the group plan, what happens to the group premiums? But the pre-existing conditions under Obamacare, that went away. They cannot, she has enrollment periods, right? So yeah, she's gonna have to do something because of the fact that she already has insurance with her employer. If she reduced her benefits with the employer, then that's something you want to look at. Yeah, that's what you're saying is kind of a red flag for me. If she removed, yeah. It sounds like they sold her a Advantage program. And it's Sutter Health, so I would wonder, like, why would they do that to her? They're in medical. They're in the medical field. Oh, it's high pressure tactics for sure. Yeah. And that's where she goes to an advocate and sees if they can advocate for her. She can also call HICAP, which is a free service, and there's attorneys there that she can talk to. She can ask. Yeah. I don't know the number. I should know it. It's probably in the back of the book though. All right, we gotta keep moving forward so we can take a break. All right. Any questions on the 5 ways of managing risk? Okay. Pretty simple concepts.
We're going to go back to cost sharing.
Absolutely. It's in chapter 9. Yeah. Definitely need to know that for sure. All right. So if we're looking in the textbook, which we have been following the textbook,
Absolutely.
we will be on page,
The big thing.
yes, we will be on page, let's go back to 6 because I did not cover this. Kind of did, kind of didn't.
Big six.
6, back to 6 for just a quick minute. In the top, under the law of large numbers distinction there, which we already talked about, you see a loss exposure. Words mean what they say. A loss exposure is the exposure to a potential loss occurring. Did I say words mean what they say? No joke. They truly do. If you have a personal loss exposure, that has to do with like family loss. If your spouse dies, that would be a personal loss exposure, right? But if a business loses a key person, as we were talking about earlier, then that business suffered a personnel loss, right? So buying insurance on key persons is an example of protecting the business from a personnel loss exposure. Personnel and personal is written a bit different. It ends differently. And you just have to remember personnel has to do with business and personal has to do with families. That gets a bit tricky. Now, on page 7, the wonderful author wants to talk about the operating channels. It's just really badly placed. So we're going to pause that and talk about it later. That then takes us to 1.4 on page 7, contract law. We started this conversation by saying insurance is a insurance is a contract. Insurance is a contract. Yes. Every contract, you know this from real estate, right, Kevin? There's 4 elements in every contract. Page 8, 7 and 8. 7, really. Yeah. Yeah. Chapter 7, page 7. Not Roman numeral 7, the real page 7.
Chapter 1.
Yeah. It's more like, it's like 100 pages in, kind of, sort of. It feels like.
Oh, is it?
Yeah.
Oh.
Yeah. And not the back of chapter 1.
And
And
numerical numbers.
Yeah.
I mean,
it's regular numbers.
regular.
Yeah. Look at how much is in the front here. So you there?
Chart class insurance 1.14.
Basic insurance contract.
1.4, contract law.
That's okay.
Page 7. What book do you have? Let me see.
Page 7.
Life and health?
Insurance licensing.
1.14.
1.4, contract law.
My page 7 doesn't say contract law.
That's just possible.
Maybe I'm in the wrong book.
Yeah.
Yeah, we're all looking at this. Are we on the?
Oh, you know, joke.
Yeah, no kidding.
In the wrong book.
Yeah, I think we're on two different books.
Oh, shoot.
That's why when you say all these chapters, I'm like, oh, I'm gonna start looking at the book and I'm like, maybe I'm looking at the wrong thing.
Wait. Okay, where are we at? Where are we at?
1.4 backwards.
We covered 1, we covered 2, we covered 3. Oh, yeah, we covered 4 right here. We talked about underwriting, we'll talk about it later more in depth. We talked about indemnity. Company underwriting, when you pause. Okay, we're pausing this in chapter 2. We're not gonna worry about that. And I'm not gonna talk about the stuff, but we kind of did talk about that already. We talked about reinsurance and premium facultative. We talked about the 20 classes. Wow, okay, so that takes us to chapter 2. Okay,
Okay. Contract law. Okay, chapter.
okay, let me,
Sorry.
Which I was going to jump start, but I'm going to, yeah, I got the wrong book because I gave you my book.
Oh, did you?
Yeah, remember? No worries. No worries. No worries. Oh, I have it right here.
I just need to sit in the class.
No, I have it right here.
And pay for it.
It's all right here. Yeah, I got you. I was just looking at the actual textbook instead of moving this right here, which I probably should have done. So I apologize, but thank you for putting me
Okay,
on
contract
check.
in short.
So, well, what I was going to say was this is a great time. We're in chapter 2, so this is a great time to actually take a little break. So what we're going to do is we're going to pause this conversation and we are going to take a 15-minute break, brings us back at 3:45. Okay. So enjoy your break, and then we're going to work for 45 minutes. I don't know how we're going to do breaks because this is kind of a little wonky, but we'll figure it out. Yeah. Today, just figuring out the new schedule. Normally we take a break at 3, but that's only after an hour of work. So yeah, maybe we'll take lunch at 12:30 to 1:30 instead. No, because you're in the middle of the lunch rush. Yeah, we'll just keep it. We'll just figure it out. I know that you wanted to work straight through, but I think we just need a little break to reset real quick. All right, 15-minute break, 3:45. Get back to work. You got longer than, and we are on chapter 2, by the way. Enjoy your break. Yes. Yes.
So I'll do, I'm gonna take the whole class.
Yes.
Sunday's just a wait. Sunday accredited towards you,
Sunday, there's no class.
or Saturday, sorry.
Saturday is an exam prep. You're not going to need it if you're not going to take the test.
Okay, yeah, but it's not.
You're so
it's-
lucky.
It's not a day where it's gonna be accredited, right?
No.
Because wouldn't I get hours for these?